Good afternoon, everyone. Appreciate everyone taking time to participate in this specially called meeting. It seems like we're having a lot of meetings all of a sudden to kind of take care of some issues here at the end of the year. So we appreciate your taking the time to be with us this afternoon. I believe we have a quorum, and so I'd like to call the meeting to order and begin with the opening statement. And I guess Eric is going to be doing the opening statement. If you would proceed, please. Thank you.
No problem. This is a special meeting of the County Employees Retirement System Investment Committee. This meeting is being broadcast via video teleconference pursuant to KRS 61-826 and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road in Frankfort, Kentucky. It is also being broadcast to the public live via Facebook. If you are speaking and are not appearing by video, please identify yourself before talking. If the video or audio broadcast is interrupted, we will attempt to reestablish a connection. The connection cannot be reestablished within 30 minutes. The meeting will be adjourned and rescheduled to a later date.
Thank you, Eric. Sherry, would you take the roll, please?
Yes, sir. Dr. Hackbart?
Here.
Mr. Cheatham?
Here.
Dr. Milkman? Mr. O'Mara?
Here, sorry.
Oh, you're fine. You're fine. And Ms. Pendergrass?
Here.
Thank you.
We have a quorum, so we can proceed. I understand there are no public comments to be shared this afternoon. Is that correct?
That is correct.
Well, this afternoon we have two agenda items. The first one is one of a timeliness issue, and that is a real return investment opportunity and recommendation from our staff. And of course, the second, the principal reason for this meeting originally was for our conversation to focus on the strategic plan. So we thought it'd probably be appropriate to start out with the recommendation to begin with. I assume most of you had an opportunity to review the basic suggestion that's being made, the type of investment it would be, but I would like to ask Steve or Anthony, or both of you, to proceed with a discussion of this recommendation, why you feel it's important, how it fits into our overall portfolio, and anything special about this particular investment opportunity that you want to share with the committee this afternoon.
Sure. Thank you, Dr. Hackbart. I'll provide an overview and then hand it off to Anthony for some details, and then happy to answer any questions. Sherry, this is fine right here. So we really appreciate everyone's time and flexibility today, especially on such short notice, to allow us an opportunity to present this investment. I also want to specifically thank Sherry and her team, herding cats here for us and putting together all these meetings. I know that's a lot of work. And also Vicki, she's done a great job. We've had a very compressed time frame here, a lot of legal work to do, and she's done a great deal of work, so we appreciate that. As we've discussed at past meetings, staff has a very constructive view on industrial transportation assets as real return investments, and we've been actively exploring several alternatives which we think would be complementary to the existing portfolio, especially to the barge leasing investment that we made last year. And really, Anthony deserves all of the credit for sourcing this, what we view as a compelling opportunity. We've been engaged with ITE and monitoring this specific fund for more than 5 years. Following their acquisition of SMBC Rail Services, the firm closed fundraising for the rail fund, essentially shuttering the fund to new investors. And through his efforts and persistence with ITE, Anthony was able to position KPPA as a frontline investor should an opportunity arise in the fund, which is the catalyst for the opportunity we are presenting today and one of the timing elements why we need to have this as a special called meeting. As you're aware, for several years, the portfolios maintained a structural underweight to the real return asset class. We've talked about that on several occasions. As really there was a lack of compelling investment opportunities, especially on a risk return basis compared to other asset classes. With the recent changes to the IPS allocation targets, as well as evolution in the market, real return has been a focus for staff over the last 18 months, as evidenced by the number of investment recommendations we've brought before the investment committee and the board, especially over the last year. Currently not accounting for capital already committed to strategies but not yet called by the managers. All of the CERS portfolios are within their allowable IPS ranges for the real return asset class, but are about 240 to 270 basis points below the target allocation. When fully funded, this investment would represent approximately 100 to 110 basis points of fund assets and would be funding through existing cash positions and rebalancing of currently overweight asset classes. On a prospective basis, including this investment, when capital already committed is fully called in the portfolios, all portfolios would be at or very near their allocation targets for the real return asset class. As we talked about in several of these presentations, we view the real return landscape as very broad, encompassing a multitude of potentially public and private asset classes. And staff focuses on sourcing and reviewing differentiated real return investment opportunities that we feel have compelling economics, favorable standalone risk-adjusted returns, low return correlations to the current real return investments, as well as the broader overall portfolio. Investments that provide sensitivity and inflation sensitivity and meaningful diversification, and provide yield and current income often through contractual cash flow streams. We believe this investment meets all of these criteria. ITE has a well-resourced and aligned management team, and the fund benefits from a unique modernized approach to a historically stagnant asset class. And we really prefer the pure play strategy of the rail fund, given the favorable specific economics and characteristics of the asset class, as well as the broad underlying diversification of the portfolio across railcar types, commodity, leasing, age, and lease expirations. And we believe this fund has demonstrated consistent yield through different market cycles while providing downside protection through assets with long useful lives and residual values. For this specific investment, we would expect capital to be fully called and deployed quickly, with the majority of the commitment invested over the next 2 quarters. So that's a benefit. Specifically, there's the catalyst for this recommendation was an opportunity to invest on a secondary basis that would need to be completed by the end of the calendar year, with the additional capital that we would commit being called over the next 2 quarters. With that, I'll turn it over to Anthony.
Thank you. Sherry, can you go to the next page, please? Thank you. Like Steve mentioned, there's a slide we've had before, kind of talking about the things that we are looking at broadly within real return on an ongoing basis. So the first bullet is this recommendation. There's also an opportunity to add to our existing investment in the barge leasing fund as they found more opportunities. And so that's something that could happen in the first part of next year. The second bullet is sports. You guys may have seen the news that the NFL has allowed private investment into teams to take minority stakes. And one of our managers, Arctos, has transacted. They have bought a piece of the Buffalo Bills, and Ares, a competing firm, has also bought into the Dolphins. So those are the first two transactions done by institutional investors. And there's several active deals right behind that. So there's an opportunity to invest there, which is part of our thesis, mainly around the top 4 U.S. sports leagues and the scarcity of those assets and the contracted cash flows that are just going to have low correlations with the rest of our portfolio, especially public equities, public affairs, things like that we can access cheaply for risk. So after that, you can see some of the other things. You may remember the oil and gas continuation vehicle we did last month, and that there's still opportunities in that. More production-focused energy, where there is cash flow coming through. There's also maybe some upside from further drilling, but it isn't as speculative as maybe it was in the mid 2010s, where there's a lot of money raised for the fracking and maybe some tiers later on. So, and then there's some other areas that we're still looking into that could be of interest. But yeah, it's definitely an attractive area right now, and so these are some of the things that we've been working on. So, Gary, could we go to the next page, please? So this is a summary of ITE. Like Steve mentioned, we've been following this for several years now, and we just had a chance to invest as they are closing the rail fund. They also are trying to get into other transport modes, so intermodal containers, aviation, also some inland marine, but that's in a more diversified fund. And I thought that the we thought that the dynamics that are just particular to rail were attractive. Like the barge leasing industry, the supply is not is the supply picture is quite good because it's constrained. That wasn't the case maybe 5 to 10 years ago, which is again why we have not done lots of real return. There's just it just was not as attractive. But now the dynamic has rationalized, and if anything, it's gone the other way, where the utilization is very high. People need equipment, and this is a relatively low cost compared to the actual goods that are being transported. So most of the time, I think lessees would rather have the equipment on hand and be able to use it if they need it, rather than be short. So because that's a much larger cost. So so that's why it's been a very favorable dynamic. There is scrapping in this area as well. Most of the supply right now is basically just replaces retiring cars. It's not like this isn't something that's speculatively built and we're going to have a whole glut of rail cars and lease rates go down. And I mean, that is a risk, but that is not something that we anticipate. And you can also kind of look at earnings calls from some of the publicly traded players, and they are also not seeing anything like that. If anything, it's the opposite. The lease spreads they're getting on the new leases versus the expiring ones is upwards of 25 to 30%. So that's going to continue for at least a few more years, and that's another reason why this is attractive. There's a lot of visibility into these portfolios. They, like Steve mentioned, they pay attention a lot to the diversity of both counterparties, also when the leases are going to roll off, and commodities carried. So it's diversified along a lot of different dimensions. And so with if these contracts are 3 to 5 years or so, then every at the beginning of every year you already know maybe 70-80% of your cash flows because they're on contract, and then you may have a chance to lease them higher if you're in a higher rate environment or higher leasing rate environment like now. Or you can, or if the rates do go down, then try and make those contracts a little shorter, so you'll have another chance to reset them. So those are kind of some of the things that our manager could do. This is not something you can just passively come into. It requires knowledge, relationships, understanding of how to do this. You can do it as a financial player and just buy some cars and have the makers, some of the manufacturers, manage it for you, like a property manager if you're having your own rental real estate. But obviously, that's going to cut into your margins and your returns. This is something where IT has both areas of expertise, both the financial capabilities as well as the maintenance and repair through the acquisitions and the platform that they've built. So here we go to the next page. I think Steve talked to us a little bit earlier. This is kind of where our allocation is now. And then the next page would talk about, he illustrates what he was saying about what it would look like when things are fully funded.
And
Steve, do you want to add anything there? Yeah, go ahead.
Yeah, importantly here, when we consider the overall real return portfolio, we're really looking to build something that is well diversified. Sizing wise, we look at the volatility and the expected returns for investments. In positioning this is, if it was fully called, if we look at where we would be fully called, that the rail fund would be about 14% of the overall real return allocation. And this is with the real return allocation at its target or at the current target for the IPS asset allocation. So it's a very durable portfolio, well diversified. We have a mix of lower volatility investments with obviously like the Tortoise Midstream potentially being a little bit higher volatility. So it's a nice complement to the existing portfolios. I would point out the one thing we do still have in there is that cash tied up in litigation that ultimately we expect to get relief in. That will need to get invested at some point. But this would nearly complete, at least bring all of the portfolios to their target asset allocations.
All right, we can go to the next page here, please. Okay. Well, this is our memo. So again, IT is a transportation-focused manager. They've accumulated over 120,000 rail cars in their fleet. The strategy is mainly to lease them on multi-year contracts to a diverse set of lessees, carrying a lot of different commodities that are essential to our economy, and then managing them also so that they're for the best utilization and also maintenance and repair to make sure costs are in line. They started over time. Their main differentiator was an operating partner they had who had run a leasing business that was owned by Carl Icahn, and that eventually went public, called American Railcar Industries. Eventually, the person who had been a founder and CEO of that company for over 10 years joined IT as their senior operating partner. So with his expertise and relationships combined with two of the founders, they were able to start building a fleet, building relationships, and source cars. Over time, the past 10 years, there's been 3 significant acquisitions they've made that have really enhanced the fleet, that have also come with some of the repair and maintenance network as well across the country that you can see on the bottom here of this page. And so these are some things that differentiate them from a few of the financial buyers who have bought in a few thousand rail cars here and there. This is a significant operation that is combining both just the financial part as well as the operational part.
Yeah, and I think that, as Anthony said, that repair and maintenance network that they have is a real differentiated approach, and it provides a lot of additional benefits away from just control and cost. They utilize that network to provide a lot of a data advantage that really benefits the portfolio management and underwriting. So it provides them a significant amount of data that may not necessarily be available to those pure financial buyers that Anthony mentioned.
Mm-hmm. So, but yeah, we're happy to take any questions you have. I mean, this is an opportunity that is of interest. It's an open-ended fund, so people are able to redeem their capital once a year. The opportunity came along for us to be able to be some of those folks that transact with people on a secondary basis, as well as have some other direct access into the fund. So that is the reason for the timing. And yeah, happy to answer any questions you'll have.
Sure. Well, thank you. Thank you for the presentation. Just a couple of questions. Trying to get a better feel for this industry, if we might want to call it industry. First of all, I assume that when this fund was established, they purchased stock from the existing railroads at that time. I assume is how they got started, and then they've been buying and selling equipment, rolling stock from time period to time period, and it's expanded now to 122,000 rail cars. Is that a big number or a small number? I have no idea how many rail cars there are.
Right. There's about 1.6 million in the country. If you look on number page, let me find the page for you. I'm sorry. There's a chart on here in the deck about the top players. They're the number 3 player. Mm-hmm. So let's see, Sherry. I'll find it for you. I'm sorry, my computer's not cooperating. If you go down a couple pages, Sherry. Let's see which one it is. Keep going. Another one. Not that one. Nope. That one. Yep. So they're the 3rd. So there's 2 other lessors that are larger, but adding the SMBC fleet last year almost doubled them. So they were around 50 to 60,000. They had another 50,000 or so. And so that places them as one of the significant players in this industry. Does that help?
So there is competition in this industry with the other.
Absolutely.
Similar.
But I think one thing that's helpful for is that the lessees obviously do not want to be tied to any one lessor. So it's kind of a not comfortable necessarily, but it's competitive, but there's also only a limited number of players. So you're not going to put all your eggs in one basket with IT. You're going to spread some out to some of the other lessors, but there's going to be some for all the people. And these are, necessary equipment for the lessees.
So do these different firms specialize in different regions of the United States, for example, Northwest, Southeast, and so forth? In other words, do they provide stock to different railroad companies, or are they national in scope in terms of providing and leasing to
these
rail companies?
These are national in scope. There can be some regional part, but these large players are national in scope. Your GATX of the world, people like that, banks. Trinity is a manufacturer, but also has its own fleet and manages some cars for outside people. So, I mean, yes, these are nationwide people.
So, rail companies, but probably just sort of a peak load option in case they need additional stock, I assume is how the structure works. Okay. Thank you. Other questions?
I've just got one question, and kind of follow up to Dr. Hackford's. If I read the material correct, we got to put funds in, we got a 2-year lockup, is that correct?
That's correct.
Yes.
It's open after that?
That's right. Once a year.
What would be, or what would you anticipate the effect if this company sold out to another firm, would this fund stand alone, or would it roll up into another offering?
It's a great question. You see that more and more with asset managers these days, and that is a concern. I think that we just have to take it as depends on what the transaction would look like. But I would think that, if someone was acquiring this, they want it like it is because it's quite attractive. So I would think they would be likely to keep it as it is, but to obtain the capabilities on their platform, but without knowing exactly who the deal might be with, it's hard to say. But in that kind of situation, the legal docs, I think, call for our ability to withdraw or make changes as needed.
That would be my next question.
Mhm.
I mean, you've got the ability to make that choice at that time.
Mhm. Yes, because this would be a significant change. So yes, I have to look into actual provisions, but yes, there's usually provisions like this when firms or other changes are made. Like I think there's one we were looking at today through the docs. If there's a transfer of up to over 25%, maybe Vicky, if you can see that, I think it's that has to be notified as well.
Could you talk a little bit about the cash flow from the lease payments? How does that determine?
Yeah.
How do we share in the cash flow and so forth, if you would please?
Sure. I mean, there's an option to have income distributed. So they have a 6% option. We would probably be more likely to reinvest given that we have been underweight in the real asset area. But for the folks who, like the income that's available to them. So
Yeah,
they
I think it's
definitely
a quarterly distributions
Mhm.
if elected.
Thank you. Other questions? If there are no questions, I guess we could move toward consideration.
Mhm.
Would someone like to make a motion to approve this recommendation and move it on?
And just to specify that the recommendation is to invest up to 200 million contingent on successful contract negotiations.
Okay.
I'll make a motion that we make that recommendation to the full board.
Thank you. Is there a second, please?
A second.
Motion's been made and second. Any further discussion or comments? If not, we can proceed to vote. All in favor of accepting this recommendation and moving this recommendation onto the full board, please indicate by saying aye.
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 Opposed? Opposed, none. Motion carried. Thank you.
Thank you.
For your
Thank you
presentation.
guys. Appreciate it.
So we appreciate that, and so this will be coming up later this afternoon. So this is we appreciate the work that you put into it and good information. So thanks a lot. Next item, I'd like to turn over to Betty Pendergrass on the CERS strategic plan. This is a plan that's been worked on for several months, and I think Betty's put a lot of hard work into this effort. And if I understand correctly, this is the one component of the full KPA family that has not been completed, if I understand correctly, that the rest of the items.
CERS board
Okay.
plan.
Okay. So Betty, if you could start out with a little background of how we proceeded on the development of the strategic plan. If I understand correctly, this would be the first strategic plan. I assume that prior to K and C, there was a strategic plan in existence for the pension system, or was this a new initiative?
This is a new initiative altogether.
Right.
Brand new. It was on my radar when our CERS board was created in April 2021. We spent the first year of the board's existence getting organized, getting our basic policies in place, and just getting up to speed on our roles and fiduciary responsibilities. So in March of 2022, I proposed this format that we're using for the strategic plan that includes goals, objectives, measures, and targets. The format is based off a plan that I found in Colorado for a pension system out there. It looked very interesting, and it had features to it that allow us not only to identify strategic policies, but to monitor how we're doing in terms of those strategies. My goal for this project was for the trustees to take a hard look at what it is that we want to accomplish with governance for the CERS retirement system. So that's how we got to where we are. If let's see, Sherry, if you'll go to the next page. This is the structure for the format for the strategic plan. There's a primary goal. I separated the goals based on the committee structure that we have and asked each one of the committees to come up with strategic ideas and issues that they wanted to pursue over time. And then within each goal, there are a series of objectives, things that we want to try to accomplish. And then we go to measures and targets that will help us monitor how the system is doing based on where we thought would be a good place to head. The strategic plan would be something that we would update every 3 to 5 years, depending on how things were going and if there were any major changes that we wanted to address. Goal 2 will be incorporated with the goals from the other committees, and in January I'm hoping to that Mr. Cheatham will schedule a special meeting in January, which is normally a month that doesn't have a whole lot of meetings, where the board can come back and look at the final draft of the entire plan for the CERS board, discuss any polishing and revisions that we need to make to it at that time, and then hopefully approve our strategic plan for 25 to 29. So I'd like to start first with the memo that I have in the packet. Sherry, if you'll go back one page, please. We met in August and went through a series of discussions on each one of these 3 objectives that are currently in the investment committee strategic plan. And so the memo kind of outlines some of the changes that we've made. I want to thank Steve and his team, and Mike Lamb and Ryan Barrow for working together to come up with the recommendations that we're putting on the table for you today. And with that, I'd like to shift over to page 66 in board books. And I'd like to turn it over to Mike Lamb to talk about some of the financial information that he researched to try to, what we were trying to come up with were some measures. One of the questions raised by the committee was how much of our resources should be generated by the investment portfolio compared to contributions and other things. So we looked at financial information, and I want Mike to kind of summarize what he found in terms of the research he did.
Thanks, Betty. This chart is a 10-year history of the resources that have come into the CERS. I believe this is the non-hazardous plan. So you see the employer contributions over time, the member contributions, realized gains, unrealized gains and losses, interest to dividends, and then the benefits that got paid out over that 10-year period of time. And what we concluded with this slide, and if you page down one more, you'll see the hazardous chart as well. Same factors, is that there's a lot of volatility in especially the unrealized gains and losses, quite a bit of volatility in the realized gains and losses over that 10-year period of time. So we didn't know if this would be a good indicator or a measure to incorporate into the strategic plan. So we decided to take a 5-year cumulative rolling value of these items. So the next page shows the 5-year cumulative of those same measures. This is the non-hazardous. And you see that the unrealized gains and losses are still somewhat volatile, but you get a lot of stabilization in realized gains. The interest and dividends also stabilize quite a bit. And so with that, we decided to incorporate, with Betty's discussions and guidance, a measure that took into consideration a 5-year cumulative total in each of these categories, specifically realized gains and interest and dividends. And so the next slide shows you the hazardous plan using that 5-year total and that stabilization. So, but if you want me to keep going, I'll go into the detailed chart that's on the next page.
Yes, please do.
So that's just the financial data of those 5-year totals. And we then looked at, well, what do we take? Betty's question was, what sort of investment income do we want to use, and what measure do we want to have to help sustain the plan on an ongoing basis? And so there's lots of calculations in here about whether we take just interest and dividends against benefits paid, against total income, and against investment income. And eventually we decided to come down to a 5-year cumulative average, just using the net. So net of fees, we've taken all the fees out using realized gains and losses, interest and dividends in comparative to benefits paid. So we're leaving the unrealized gains and losses alone and out of this calculation because they're not realized and they may take several years to come to fruition. But realized gains and losses are things that have occurred, and interest and dividends are ongoing income that we can use to pay benefits. So we're using that ratio of net investment income plus realized gains and losses against benefits paid. And so those color coordinations at the bottom are just different ratios compared to investment income, compared to total income, compared to benefits, etc. And so we did that for the hazardous, and the next page is we did that for non-hazardous and hazardous. And then there's a summary of all of those calculations using the color coding. And as I mentioned, we decided a net investment income plus realized gains compared to benefits paid. And that's been the average over the 5-year period of time. And the range, we saw some years that had 40-something% of benefits paid and some years that were 60-something%. So that's the range that we kind of came up with for the strategic plan.
Thanks, Mike. Any questions about how we stepped through that research? One of the objectives that I thought was important is that we do not want to use all of the investment income and all of the realized gains on benefits. We want some that is held back into the system to fund future benefits and weather any kind of ups and downs and volatility that we might have. The other thing that I wanted to be able to do was to track how this was occurring as we move forward on an actual basis. So Mike and I are going to go back to the cash flow report that we already generate for the system and find a way to add some information to maybe another column in that cash flow report that will allow us to monitor how well we're doing. So where we went from this range that is on this page to the numbers that we put in the strategic plan, which is that'll be on page 64 of the board books. This is all in objective A, and the first measure was what kind of geometric average should we look for? And we landed on this 5-year geometric average because that is another measure that is applied to the tier 3 asset interest credits, earnings credits that are applied to the tier 3 um, um, member benefit or member portfolios. So we were looking, we are suggesting that gainer should range from 6.25% to 10%. And then the next measure deals with the cash flow that we've been discussing here. And we are suggesting that the investment component on a 5-year rolling average should range between 45 and 65%.
Betty, were you able to determine, are there comparable figures for our peers in terms of their utilization of that type of income to meet the beneficiaries?
We do not have a peer group of systems that has been identified yet. That's something I had hoped we would do a year or so ago, but we don't have those peer groups in place.
So if we went with this range, would we be making sufficient progress in our overall funding ratio? I assume that, in fact, to a degree, we vary this percentage. We'll be adding more to our basic funding or less to our basic funding, and therefore that would affect our ultimate funding ratio, correct?
On the low end of this range, if we only use 45%, if investments only provide 45% of the benefit payments, then a large chunk of the investments will be going toward paying down that unfunded liability. If we get to a higher end, then I would expect that our progress on the unfunded liability would be slower. So this is a measure that we would need to coordinate with the actuarial committee and provide that information to them when they are looking at assumptions and their strategic goals for the system.
That interaction is what I thought I had sort of had in mind. Is it would sort of be a next step to see how that would affect the actuarial analysis, correct? Different ratios.
Yes, and I think that would be a good discussion to have in January when we look at the entire CERS board strategic plan.
Betty, just for a little clarification, you're looking at setting these parameters for the period specific to this particular iteration of the strategic plan, correct?
Yes, this is something that if we monitor it over the next year or two and find out that these ranges are not really reflecting what's happening in the portfolio, we can come back and review this and take another look at it. We can figure out, number one, why are we not falling within these ranges? And number two, what can we do to adjust?
Well, I would also think over time, these will be time sensitive based on the maturity of the plan itself.
Yes, as we get fewer tier 1, tier 2 members and more tier 3 members, this is going to change. Tier 3 has no unfunded liability. Tier 3 members will get it. They have an option to take a lump sum distribution or to take an annuity based on the account balance on the date that they retire. So the unfunded liability belongs to tier 1 and tier 2. So as we move closer to tier 3 being the majority component of the plan, then this all changes a lot.
Mike, I think you gave us that number at one of the last meetings. I can't remember what it was. Is it 40% now? Does that sound right? Of the active members?
If I did, I don't recall what it was, and I don't know if I was the person who gave that number. It might have been Aaron or Rebecca. We should have that. The total of tier 1 and 2 that are compared to the total membership, we have that somewhere for sure.
And I suggested in a finance committee meeting that we need to add the membership breakdown to our quarterly reporting so that we can see that number on a regular basis and use it to evaluate changes that are happening both in the actuarial analysis, the investment monitoring, and the financial assessments. It's a pretty important number. We used to get and this was, I want to say 5 or 6 years ago. Rebecca will be familiar with this reporting that we were doing. We did, because we had a high volume of retirements coming through the system. So we were tracking that on a regular basis, and we had some monthly and quarterly reports that told us how many people were moving from active status to retired status. So we might want to reactivate that report as well to keep track of how our membership demographics are changing.
Betty, that this percent is sort of a residual, I assume, after we determine the contributions from employers and employees relative to outward cash flow. We would have to draw on investment income to meet that number. Is that correct?
Yes, this is the portion of investment, interest and dividends, and realized gains that we are using to fund benefits.
To supplement cash flow from employers and employees.
Right.
Fiscal year basis.
And as our Tier 3 component grows, more of those contributions need to stay in Tier 3, not pay benefits for Tier 1 and Tier 2.
I think it's very useful information, Betty. I think good work. I think it's interesting.
Thank you. Now, on Measure 3, this was a question that Mr. Cheatham raised. We've actually researched this before. Mr. Ramsey, a former trustee in 2017, 2018, I think, took a look at this specific issue, and he determined that at that point the systems were not in a funded status that would allow this to happen. But I don't know that he separated the CERS system from the KERS system. So I've asked Steve Willer to take another look at this one, and he has some background information on how this type of issue might go for us. So Steve, if you'll fill in some of the blanks there.
Yeah, for LDIs, what you typically see is they're most successfully implemented in what are called hard frozen pension plans, which are no longer accruing liabilities. For soft frozen or for open plans that are still accruing liabilities, it's difficult to implement LDI because you need to take more risk, especially with a lower funded status. And so the assets available in order to fund that LDI strategy are in excess of what's available or would be prudent to do so. So I'm not sure. I think we have some more work to do here, and I want to bring back to the committee and to the board some additional color on what options may be available. But I think it would be, at this point in time, it would be difficult to implement, and I don't think from an economic standpoint it would be feasible.
Mr. Cheatham, does that help with your question?
A little bit. I think we've got to review where our funding status is compared to where it was 5 or 6 years ago. And as you said, what metric did they use at that point in time? But you can also sit and look at our system, and you can almost sit there and say, all right, we're really operating 2 systems, if not 3, between Tier 1, Tier 2, and Tier 3. As you pointed out, Tier 3 doesn't have any liability. So it's really more, in my mind, a question of bucketing as to when those benefits are going to be due to be paid.
And I will say, so you see it more often in corporate pension plans, right, that are hard frozen plans that are no longer accruing liabilities, and they have a funded status near 100% funded. That's when people start to get interested in LDI investing. especially is when you're close to that point of fully funded and no longer accruing liabilities, and economically it can make sense, and you have sufficient assets essentially to go out and buy the investments that are going to generate the income over the period of time when they're going to be paid. So I think it's worth, and to your point, I'm not familiar with a from a class breakdown or a participant class breakdown, what specifically might be, where the status might be, as both you and Ms. Pettigrew mentioned, that tier 3 is obviously very different than tiers 1 and tier 2.
Which begs the question, to some extent, they need to be managed somewhat differently.
There's certainly an argument that can be made there.
So my recommendation.
I'd rather us make the argument than somebody in court.
Good point. Very good point. My recommendation on this particular item is that we take this one out of this particular strategic plan, leave it on the back burner, and the next time you look at a strategic plan, the numbers might be a little more feasible in terms of trying to do something meaningful.
And we can provide some additional information, do some additional digging in the meantime as well.
Right. Steve can help us keep that on the radar and come back and look at it in a future.
Betty, just one more question in terms of the relationship. If we were to retain such a component and the actuarial analysis, in effect, suppose we set this at 30% or 40%, that would be input and information that the actuary would use in determining what the contribution rates would be a factor there. Is that the way you view it? In other words,
I'm sorry, I'm not sure I understood that. Are you still talking about liability-driven investment options?
Right. I think in terms of this percent of contribution and payments options.
Oh, you're back on measure 2.
Yeah.
Yes.
Yeah.
Okay.
If we set a goal there that would be 30% or 40%, that would be information that the actuary could use in determining part of the information that the actuary could use to determine what the contribution rate could be, because there'd be a limit or there'd be a goal of what percent of the benefits should flow from cash flow from contributions of employees. So
I think that would be a question for Danny White. We might ask him to join us for the January meeting so that we could integrate the investment measures and targets with the actuarial measures and targets, and see where we have overlap, see where we have relationships that we want to track on an ongoing basis, and see what he can include or add or highlight from the annual evaluation.
yeah, this appears there's significant interaction between the two, and I'm just trying to make sure.
Oh, very definitely.
Right. Okay, thank you.
Now, on objective B, we pretty much worked this one out in our August meeting. There's been a few wordsmithing changes to this particular section, and in particular under measure 2 and the targets. And again, I'm going to come back to Steve Willer. What I was trying to do is to look at our quarterly performance reporting and highlight those issues where both the investment committee and the board want to focus on some key performance measures that might be important. So, Steve, if you'll explain how we got to some of the terms that we used for these targets, please.
Sure. I think in their discussion, most of this reporting is either already included in the material or complementary to the material that we are including. But to Betty's point, I think what we wanted to do was, or at least from the strategic plan standpoint, was to highlight or maybe think of some different ways. And the biggest one would be looking at that target A of measure 2. So we wanted to include in the reporting, in the monthly or quarterly reporting packages, a basis for comparing what the actual return of our asset class classes have been relative to what the assumed rates of return were at the time that the last asset allocation was completed. So that'll be kind of a static number until that's updated, but that will be included for comparison purposes relative to actual asset class performance experienced in the portfolios. The rest is currently already being reported, but especially for the gainer, the trend reporting for the gainer, we're going to come up with some ways to maybe highlight that and bring that to the forefront to show kind of more of a trend analysis than a point in time measure. So that's what we discussed it in for this strategic plan. And I think, happy to answer any questions or if there's any ideas that might enhance the transparency of this information.
So my question to the committee is, do you have additional hot buttons, key points, things that you look for in those quarterly performance and investment reporting that we get from Steve and his staff? Are there topics that you would like to see added to this list of targets?
I think one of the things that I would like to see, and to some extent they're in there, but I'd like to see them in a concise report on a manager by manager basis. And that doesn't mean every month or every quarter, but at least a couple of times a year.
That's in the next objective.
You asked what I'd like to see, Betty.
Okay, yeah, it's in the very next one. We're going to get to that one. It's there. If you go down, Sheriff, you'll go down to Objective C and Measure 2. Quarterly reporting provides an analysis of the manager performance by asset class. Does that terminology get to what you were looking for, Mr. Cheatham?
It does. Anytime you've got something to benchmark against for whatever how we've got this particular investment or manager categorized, it's helpful.
And we used to have more detail on the manager performance in our quarterly reports. So I think this measure and target will help us get back to that style of reporting. The pandemic kind of interrupted our ability to visit managers and do the updates that we had been doing in the past. So it's taken a minute to get back to that tracking and oversight of manager performance, but I think it's critical.
And one of the, sorry, Betty, one of the caveats we did discuss was we're currently providing, in the most recent investment committee reports, asset class level performance by portfolio. So the CRS hazardous pension, CRS non-hazardous pension, with the caveat that currently BNY is only able to provide those numbers on a gross of fee basis. I believe that's what was also included in the annual reporting. We're working with BNY to see if there's a solution. We actually had a call today, and that was one of the topics that was brought up. So we hope to be able to bring, because obviously there's the compositional differences of the real estate portfolio across each of the funds may be slightly different and drive performance variances over time. And we want to be able to show what the asset class level performance is by portfolio.
So that's one main reason why I didn't put more information in here on that, is that we still have some work to do to climb that hill. Mr. O'Mara, you have a question, comment?
Well, question to a comment, I guess. How many managers do we have now?
Active managers, and then we have a number of managers in runoff. Obviously, the majority of those runoff managers are small in overall AUM and predominantly in the alternative asset classes, but our roster is about 80 investment managers.
And that excludes the equity market.
So that's inclusive of our individual equity mandate. So the individual asset managers that we have for equity. We have some assets are managed internally, some managed or external for public equities.
Well, I'm looking for valuable information rather than just gross data. Uh, I think a discussion, uh, you you could have a red light, green light of those 80 reports to see who is below or above the 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 benchmark for that asset class,
And
or just
that's
report the ones that are below.
that's the type of reporting that we used to get. Each manager had a threshold, and the quarterly report told us whether that manager was above or below the threshold and how long they had been above or below the threshold. It was a nice condensed report.
Well, that would still have a list of 80 managers if you did it for each manager. If you just listed those, you see what I'm trying to get to? I'm trying to let us focus on those that we need to have a discussion about or review of. They've been below for 2 years. They've been below for 1 quarter.
The actual manager visits were based on how long they'd been below the threshold, and those who had been below longer got more attention quicker.
Well, and you will know, so each of the quarterly reports does have a breakout that maybe not to Bill's point doesn't necessarily highlight, but each report does have the individual manager, their specific benchmark. So the asset class that they manage, the opportunity set, as Joe likes to call it, and then what we call the value add, which is, you know, above or below. And that's on a running basis. So we report month, quarter, year to date, fiscal year, 1 year, 3, 5 since inception. But we're happy to consider alternatives that may allow you to focus where, you know, high nails or low nails within our manager universe.
Well, if we identified a critical threshold for when we want to reconsider whether that manager is doing what we had hoped they would do, maybe we could add that to the, excuse me, let me turn this off.
Well, Betty's doing that. Bill, I don't disagree with you. However, I would, along with the watch list, the ones that aren't performing, I'd like to see who is performing, because that may be one we want to move funds to. Again, I don't know that I need that report every quarter or every time we do it, but at least once or twice a year, that would be beneficial.
Well, just point counterpoint discussion. You know, I'm trying to have us in an oversight role rather than a manager role.
Sure.
If we need to move some, that would be a recommendation from our investment staff versus us. But and to say that they're reviewing it, they've scheduled a visit, that shows us that they're actively managing our portfolio. But I'm not seeing our committee as ones to make those calls on an ongoing basis of when it needs to be done, or I'm looking at recommendations. So again, I'm trying to see us as an oversight role rather than a management role.
Part of that to me is seeing what we've got on our watch list for underperformance.
And that would be a highlight.
Yeah,
I agree with that.
yeah. Like I said, I agree with you. I don't disagree at all. I just like, for comparison's sake, see where we are outperforming in particular asset classes. Because some of it may be an issue of an asset, you know, an underlying asset class that's doing really well versus something that may still be, for example, real return that's not doing very well. You know, it may be attributable to that particular industry or market.
Well, I think we can certainly work with the committee and the board as to, enhancements to the quarterly or annual reporting. I know we actually I've talked to Wilshire, and talked to BNY, about some reporting that we may be able to implement. So I think that's a good takeaway from this meeting.
Sherry, if you could let me share my screen, please, ma'am.
You should be able to now.
Okay, what I am doing as we're going through the discussion today, let me see if I can do this, is I've added an item that to the targets in Objective B, Measure 2, an item that addresses a manager watch list that identifies managers with excellent performance or performance below expectations should be added to compliance reporting. Is that what you two have in mind?
I think so. I think that's something that gives us a track to run on to develop what we need to.
There you go. I'm trying to stay away from things that are too specific, so this gets the topic on the agenda, and then we can refine the details as we go forward. Okay? All right, then the next objective is another one where I got substantial assistance from Steve and his crew. In this one, we're looking at benchmarks that will evaluate investment performance versus actuarial analysis and strengthen our risk monitoring. Risk has been a topic that we have been discussing a lot, and is a high priority for several of us. So take a look at these measures and targets while Steve is giving us a little bit of background on where we landed with these particular recommendations.
Yeah, I think a big part of the discussion was reviewing the appropriateness of each of the benchmarks within the overall asset allocation targets, as specified. And one of the ones we've obviously talked about at length is the private equity versus the public equity benchmark, and the volatility and that introduces in relative performance, as well as really the difficulty, especially over the shorter term, evaluating the actual performance realized in that portfolio. So enhancements we can make there, suggestions we will make to the investment committee and the board, and we've talked with Wilshire about alternatives. We did discuss at one meeting the benefits and the drawbacks to some of those, but the additional discussion was the reporting enhancements that we can make at both the overall asset class level, the overall portfolio level. That again, while we may be reporting volatility in a number of different metrics, where we can make enhancements to those, to Bill's point, as more of an oversight, not necessarily specifying, but giving an idea of how we're doing, right? How we're doing. We talk about that when we highlight in the quarterly investment meetings the Sharpe ratio for the funds. How much return are we getting per unit of risk? How does that stack up with our peer universe? Is that the efficiency of the construction of the portfolio? That's a really important measure, and it tends to normalize that risk across peer universe, which is often difficult to accomplish. So I think this was really just looking at where we can highlight both fund performance at the benchmark level and at the peer universe level. We're working with Wilshire to maybe establish a couple of different universes. We talked about the difficulties with that. You can't if you narrow it down and make it too specific, your peer universe too specific, it doesn't really provide much good information. And what specific, fund size is not necessarily the greatest metric to use to establish a peer universe. There's lots of other things. So we've talked about from an asset allocation perspective, some bands around that might make it more relevant as a comparison. There's a funding status one that's available. I don't think that's something that Wilshire currently does, but there's some other providers that look at funding status and potentially constructing a peer universe as well. But that often leads to asset allocation, right? So I think those tend to go hand in hand. So I think we can probably achieve it by creating a universe that is more reflective of how the CERS assets are being managed.
And I think we have two types of peer groups. Wilshire has been providing us some peer analysis in our investment returns, but I think there's also the opportunity to identify peer systems that are similar to us in terms of how the benefit packages are structured, how the governance structure is organized, and that's an additional peer group that I've been hoping we could identify um, uh, for the last couple of years. I do a book for Thomson Reuters that is a trends and illustrations in governmental financial reporting, and I always get caught up in reading the notes and looking at the structures of pension systems because for that particular publication, we focus on smaller governments, and some of those have their own systems, some of those participate in statewide systems like ours. So I think there's definitely an opportunity to find some other pension systems that are organized and managed and structured very similar to how we are, that we could do some of what Dr. Hackbert was suggesting with Objective A is compare our strategy to what it is they're doing in their systems. And with a smaller group of peers, we could have that opportunity to actually talk with managers and trustees in those other systems to compare our similarities and our differences that might cause variations in what works for one system but doesn't work for another. I'll go back to the session that we had last January where one of the individuals who was providing some information in that training was actually a trustee for one of the Arizona public safety systems. So he brought a lot of hands-on discussion to that particular training session. So I think we can do, with a little bit of research, I think we could find some peer groups that would be very helpful in helping us to try to identify whether we have a strategic goal that is workable, not workable, looks good, doesn't look good compared to what some other folks are doing in the country.
Betty, we touched on this a little bit in our meeting Tuesday. David, you may want to chime in, but I think Craig may have indicated that you all had the ability to narrow that peer group universe down to probably about 30 pension systems that would be equivalent to ours.
Yes, from an asset size standpoint, we can do that. Not from any kind of benefit differentials, but we can narrow it by asset size.
Okay, well, that'd be a good starting point anyway.
Mm-hmm.
And we may not need to have perfect peers, perfectly comparable, because I think oftentimes when you're looking at peers, you're looking at actions that they're taking that we're not. And it may suggest adjustments in our strategies that might be useful going forward. So it's sort of an idea generator, if nothing, as much as sort of how are we doing grading ourselves compared to our peers. So oftentimes I think when we do that kind of pursuit, we get ideas that we may want to adopt or may consider. It opens up our horizons, I think, in terms of thoughts and ideas if we do something of that nature.
I think that's one of the best reasons to identify a peer group and work with them on a regular basis. To me, it's one of the nicest benefits of the CERS system, not only from being able to access other systems, but attending the training that CERS offers and being able to network with the individuals from those systems during those training sessions. All right, let's come back to objective C. Is there any wording changes that you'd like to see in the measures or targets?
Betty, I don't see anything in what you got listed that I have a question about. I would like to throw out there for discussion, and I know, you weren't available with us Tuesday, but based on part of the presentation that we heard out of Wilshire's affiliate KTP, I'm just wondering what the rest of the trustees think about whether that fits into either objective C or objective B, if that's something that we want to pursue. Betty, just to give you an idea, what they're talking about here is they have an affiliate company that they bought that focuses on cost efficiency and investment governance, not from the trustee side, but from the investment manager side.
Yes, that'd be an interesting concept. Another similar thing is there's a firm in Canada that does consulting work for evaluating a governance structure and how effective that structure is, and makes recommendations for how you might improve your governance structure. So there's always room for those kinds of assessments.
David, can you give Betty just a nutshell, because I think I may have not phrased it correctly.
No, sure. Yeah, happy to, but I think you phrased it fine. But yes, Betty, it's the firm does a incredibly deep dive into portfolio cost structure at sort of a forensic level. So beyond the level of, they dig into things that you would not expect a staff or even investment consultants to uncover in terms of minute details in contracts, documents, fee calculations, the methodology being used by an asset manager to calculate the fee, all kinds of things that they uncover through a really extensive dive into portfolio mandates.
The thing that caught my attention, Betty, is it doesn't cost us anything. We just get to participate in the savings that's uncovered.
Right. So I'm looking at objective B, which I've moved to the screen to add a measure.
Now, I'd like Dr. Hackford and Bill to, chime in with their thoughts on that, if that's something that we ought to put on the radar screen or not.
I guess I'm not sure exactly what you're referring to, Lyle. I mean, in terms of what.
Well, I think we should have a discussion at another time at this committee level. I'm not sure it rises to a 5-year plan yet.
For this new opportunity. Okay. No, I agree with you, Bill.
Might be a project for the investment committee, not necessarily part of the strategic plan.
Correct.
As embedded in the strategic plan, we're making a decision for the future, and I think we're just thinking about that as a possibility at this point in time.
Okay, then we would leave objective B the same. Any other edits to objective C?
Only, like I said, if we don't go that in depth with the wording, I think from a fiduciary standpoint that we need to add something in there. We've talked a lot about performance. I think we still ought to, have some kind of comment or reference in there to oversight of fees and that sort of thing, particularly considering where we've been over the last 10 or 15 years.
That looks like something that we could add in objective C, measure 3, and those targets. Analysis of and we have reporting on this already, analysis of management fees.
Looking at
And,
item 2, is that correct?
I'm sorry, say that again, I missed it.
Item 2 and objective C.
Put it with the managers, okay, hang on.
I mean, that's what we're talking about.
Right. I
And
was adding it to the quarterly investment performance reports.
now I think you've got a place right there in your target. You know, you've
Okay.
almost referenced it anyway with net of management and performance fees. I just need to add a quick little sentence about oversight of those management and performance fees. Because it steps right into your next measure, and that's with the compliance officer.
Okay, how does that sentence look? Periodic reporting should provide an opportunity for the investment committee to provide oversight of management fees.
I'm fine with that if everybody else is.
Are there questions on any other area? The next part of this is, there are two, areas that we will use to evaluate success. Success. One of those would be performance and compliance reports provide the key information, for the investment committee. And two, the performance and compliance reports are readily available to stakeholders on the KPPA website. And we're doing a lot of that already. So we're just looking for enhancements there. Then there is a timeline. Objectives A and C are both ongoing. And then the IPS has a date for 2025 and then again in 2029. That doesn't keep you from doing updating the IPS in a one of those middle years if you want. Any other suggestions for edits, additions, deletions on the? I think Dr. Hackbert, we're ready for a motion and a vote on adopting this as the investment committee strategic plan.
Thank you, Betty. I will accept a motion to approve this as adjusted. What would be the appropriate motion?
Revised and edited.
I will make that motion.
Is there a second, please?
I'll second.
Any other conversation, discussion, comments? If not, we can proceed to vote. Would this be a recommendation to the full board?
This would be the strategic plan for the investment committee. The board will incorporate this component into the board's overall strategic plan.
The board would accept the entire strategic plan for CERS. Is that basically the?
Right.
So this would be a recommendation for the inclusion of this recommendation in the overall CERS strategic plan. Is that?
That's correct.
Okay, thank you. Any other comments or questions? If not, we can proceed to vote. All in favor of the motion, please indicate by saying aye.
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 Opposed? Motion carries. Thank you for all of you that were involved in this process. I think this is a significant contribution and highlights a lot of issues that we will be dealing with in the future. So I think it provides some general guidance, and I think appreciate this should be another good management tool that we can utilize. So thank you. That concludes our business, I think, for this afternoon. So could someone please move to adjourn our meeting?
Move to adjourn.
Second, please. We have a second?
I'll second.
Thank you. We got a second. Motion made and second to adjourn. All those in favor say aye.
Aye.
Motion's adjourned. The meeting's adjourned. Thank you.